Let's start. Last class I think we're doing replacement decision. Let's quickly do a small warm-up exercise and then we move forward. A very small warm-up exercise. Question number 67. Quickly read out the question, then we move forward. Question number 67. It is on 31st March 2013. The following information about bond is available. Name of the security, face value, maturity date, coupon rate, coupon dates. You have first bond, which is maturity date is 2023 and you are standing on 2013 March, and it's a zero coupon. I think zero coupon is nothing but issue at discount, redeemable will be at a par value. Face value 10,000, that would be a redemption value which will come out. If 10 years yield is 7.5% per annum, what price the zero coupon bond would fetch on 31st March 2013? We have to find the present value. So basically discount rate is 7.5. Nothing has to be done in the first part. If for example you are standing in zero period and period is 10 years time and you are expected to receive a face value of 10,000, to discount by 7.5, I think we gave it is 7.5 zero period, 10th year discounting, or you can do is 10,000 future value, it's compound amount divided by 1.075 per 10, I think. First part answer. Single year discounting. Single year discounting to be done. 10,000 divided by 1.075 to the power 10. Calculate that. Zero coupon bond, no interest or coupon would come. First part. Second part is exactly same, I think. Only difference is 20th June maturity 2013. You have to find yield, annualized yield in fact. If present value is 98.50, the second part, you know the present value, zero period, you know the future value after how many days, just calculate the number of days. Number of days would come 30 days of April, then 31 of May plus 21, 81. What formula has been applied is nothing but it's if you invest 98 today and receive 1 lakh, what is your return? The general formula which has been applied, 1 lakh rupees of an investment, 98,500 you will receive, divide by 98,500. This return is for 81 days, proportionately for 365 days. You can even use 360 days. That's perfectly fine. That's basically annualized. The word was annualized return. What was supposed to be calculated. Third and fourth part are intrinsic value. Just calculate once because we'll be using a lot of intrinsic values today. Third and fourth are intrinsic values, I think. First one is one-time payment. Coupon rate is your earning rate. Discounting rate, he would give you 8%. Time period 10 year. So intrinsic value is nothing but summation of present value of interest plus present value of the redemption value. If nothing is mentioned, redemption value would be 100. Coupon is 10.71. In the third case, to receive 10.71, discounting would be done by 8% present value annuity factor. 8%. How many years? 10 years. Quickly do third and fourth part. It's just a warm-up exercise because next concept will move in slightly different. Quickly try once please numbers, because they'll help you out in the subsequent question. Annuity factor 10%, 8% for how many years? 10 years. Last one is semi-annual. Semi-annual is discounting will happen by 4%, and instead of I think 10% coupon, you'll receive half. So period will become double. 2018, 5 years means period would be 10. So normal calculation of intrinsic value, nothing else. Normal intrinsic value calculations, nothing else. Done. Now let's move to a small off-track topic from this chapter only, which is very important from repetitions point of view. Very, very important. It has repeated so many times in the exam. Recently, in the last 4 years, 3 times this topic would have come. Before entering into complexity, let's slightly get easier one. 49th I have given you, 45th I have 2 questions I have given. Let me do one from my book, since I have given 2. Show you from my book. Not have. I have given you 2 examples. We'll discuss that also. Don't worry. The question is basically GHI Limited, triple rated company, has issued. You don't have this question. You have 2 other questions which I'll discuss with you. GHI Limited, triple rated company, has put fully convertible bonds on the following terms a year ago. Face value of 1,000. Coupon rate 8.5, time to maturity 3 years, interest payment annual at the year end, principal payment, conversion ratio. Conversion ratio is nothing but basically number of shares per bond. Conversion ratio is number of, actually some terms are new. While discussing, I'll keep telling you what the term means. Conversion ratio is number of shares per bond. Current market price 45, current market price of convertible bond is 1175. The company can issue plain vanilla bond without conversion option at interest rate of 9.5. What is the straight value of bond? Now straight value of bond, technically speaking, is nothing but some bonds have a conversion option, some bonds will not have any convertibility. If I remove that convertibility option from that bond, that is known as a straight value of bond. It is also known as the investment value or a bond value. Some people call it as a pure value also. So basically straight value of bond is nothing but intrinsic value, what you find. That's exactly. and that's why he has said plain vanilla. That means it does not have any kind of a convertibility. So straight value of bond, my formula is coupon rate is 8.5. Coupon is 8.5. 1000 rupees face value. How much I'll get? 85. Discount rate. What is yield rate? 9.5. And factors he has given 9.5. Time to maturity is 3 years. I think somewhere was given 3 years. So 3 years annuity factor I have taken. 3 years annuity factor, that's 85 interest every year for 3 years plus redemption value in the last year factor. So my straight value of bond comes as what? 974.96. Second is conversion value of bond. How many shares you will get? 25. And what is the market price? 45. Multiply that. 1125. Basically, if I try to put the formula, it becomes conversion ratio into current market price. Third is basically he'll ask you conversion premium. I'll come back to it. Percentage. Third and fourth I'll come back. Read conversion parity price. Parity price is equality. Parity is equality. That means at what price you'll be equal. For example, as of now, when you convert, you are getting 25 shares of what? 45. So you are getting a worth 1125, whereas the market price of that bond is what? 1175. Parity price is at what price you will be having a parity? Tell me 1175 divided by 25 if you do. 1175 divided by 25. So your price, parity price comes as 47. That means you will be indifferent when the price of the bond will be, share will be 47, because you are surrendering a bond which has a price how much? 1175 and getting worth how much? 1125. Conversion premium indirectly represents, actually third and fifth point are connected. Conversion premium is nothing but you are surrendering a, you are getting a value how much? 1125, whereas basically parity would be reached when the price becomes what? 47, and you have a bond which is what? 1175. So the premium, conversion premium is nothing but two ways it is calculated. Market price of convertible bond minus the conversion value of bond divided by the conversion value of bond. 4.44. This percentage can be calculated, or if they want to calculate per share, basically this per share is nothing but difference of 47 and 45. Conversion premium per share is market price of convertible bond 1175. Conversion value of bond is 1125 divided by the conversion ratio. This is conversion premium. This can be calculated different ways. It means basically this price is important from investors point of view, because if let's suppose he buys a bond today and gets converted into the shares, then where does the parity come, or what is the premium? The premium comes either in percentage 4.44 or 2. The next part is downside risk. Now downside risk is basically, if you look at how much is the market price of convertible bond? 1175, whereas the fundamental price came what? 974. It's basically market price of convertible bond by straight value of bond divided by straight value of bond. Market price of convertible bond. This I have just shown you for the purpose of so that we can get comfortable in next part, because next part will have two extra parts. It's a conversion premium would be important. Anyone who is buying a bond and converting into shares, then what is the premium? And this conversion premium will have a link with the parity price, equality price, which comes out. Now two more items can come in this, which I'll discuss with you in the question only, which has, let's do a smaller question based on this. Smaller question is 40, this is 48. I think your book will have 49. Just try 49 quickly. I think your book will have 49. Try 49 quickly. Let me try out 49. The data given below relates to convertible bond, face value, number of share per bond, coupon rate, market price of convertible bond, straight value of bond. Straight value of bond is nothing but without the convertibility option, or you can assume it's a fundamental value or intrinsic value. Conversion value of bond. Conversion value of bond is nothing but if you convert this bond into shares, how much worth you are getting. It's conversion ratio or number of shares. 20 into what? Market price. 20 into the market price is 120. You are getting shares worth, or conversion value of bond is 2400. Downside risk. Downside risk would be basically the market price of convertible bond minus the straight value of bond. You can put two ways, either divide by straight value of bond or divide by this. Both answers will be valid in the exam. This is not my answer. I have taken from the 2650 2320 divided by 2320, or you can have 2650 minus 2350 divided by 2650. Downside risk. Downside means this, the value can fall to by how much. The market price you are appearing at here, whereas if you remove that convertibility, it becomes a straight value of bond. So either it could be 12.77 or any one of them you can write. If you have the time, you can write both of them. Third is conversion premium. If I ask you conversion premium, market price of convertible bond minus what? Conversion value. Conversion value. Market price just slightly changed here. If it is 2350, market price minus conversion value by conversion value. 10.42. And at what price parity would come? Parity would come, you are surrendering a bond. Let's suppose if you have 2650, you are getting what? 20. Parity would come at what? 132.5. And if you want to check now, 132.5 and 120, the difference will come exactly 10.42. 132.50, those points will be linked. With respect to this, the difference will come 10.42%. These 4-5 parts have been very common. After that, they have added two new parts. New parts have been added. Which question I have given you in your book? 24th, I think. 24th you have? Yes. Read out 24th, try first 5. Read out 24th, try first 5. Following is the data related to 9% fully convertible equity share debenture issued by Delta. 1000 rupees market price you have. Let me. ₹1,000 market price you have. Conversion number 25. Trade value of 9% debenture. Market price equity share on the date of conversion 30. Expected dividend 1. Dividend will come in the shares. Conversion value of debentures. How much is the market price of the share? 30 into what? 25. How much do we get? Next part we have is market conversion price, parity price basically. Market conversion price, parity price. It is market price of convertible bond. How much is 1,000? Divide by 25. 1,000 divided by 25. Third is conversion premium per share. He is asking conversion premium per share. Now there could be different ways of doing it. Per share, if I calculate premium, first part is you. What is your parity price coming? 40. Whereas share which you're getting is for what? 30. 40 minus 30 would be the one way of doing it. 40 minus 30, that's one way of doing it. Second is what we applied just now, the formula convertible bond minus what? Conversion value divided by the number of shares which you're getting. That's a conversion ratio. Basically, we say my market price of convertible bond minus conversion value. You are 1,000 rupees minus 750 divided by 25. Both ways you'll get rupee 10. Same. Conversion premium, or you can simply do what is the parity price coming and what was your market price, it was there. Then next part you have ratio. Ratio will not be difficult for you. Conversion premium, how much you are getting? 10 divided by 30. Conversion premium part. Again, two formulas would be there. In book, I think only one would be there. In case you want to copy the second one, it's fine. So ratio of the conversion premium. Ratio of conversion premium would be market price of convertible bond conversion value. This is one way. Second is 10 divided by 30. I think one formula would be given in the answer. If you want to put the second part, it's up to you. In this case also, I think the first one was given. Second is market price conversion premium per share can come as total divided by number of shares. Basically, you calculate total or individually. Similarly, in the case of ratio of conversion premium, it's conversion premium per share divided by the market price, or the convertible bond minus the conversion value divided by the conversion value, which comes 33.3. The next part is clear cut asking premium over straight value. Premium over straight value. Premium over straight value of bond is nothing. Straight value of bond is what? Intrinsic, or you can imagine fundamental value without convertibility option. 800, how did you get? Did he give or we calculated? He has given straight value of debenture C. He has given E partner. Market price of convertible minus straight value divided by straight value. Now before I do the next part, I'll just take up small numbers to understand what exactly the next two part mean. They are slightly new or could be different from the normal ones. These 4 or 5 part comes in every question, almost every question. The next two parts come only on and off comes in. So I'm putting in the next two parts. Before we discuss the next two part, let's small numbers. I'm just taking a small number. Example, let's suppose I have face value on 1,000, on rate 4%, conversion ratio market price of convertible bond 1 face value is 1,000, on rate 4%, conversion ratio market price of convertible 1130, share price of the share and dividend. But I'll ask you some question just now. Is 0.5. Tell me the first part. Conversion premium. Want to copy? That's your choice. You can see from here. Conversion. So what we'll be getting? 1130 minus what? 50 into 20. How much? You can put as 2. Fact. 2 into 20. How much do you get? 90. It means to buy this bond, actually if you get a shares, you get share worth rupees only 52 into 20, and this bond is asking you extra how much? 90 rupees. Now why this extra is paid? Understand the language of it. Why should someone pay extra 90? There are two reasons of paying. One, if he takes a convertibility bond or convertible bond, he has first interest income is coupon is how much? 4%, which is higher than the dividend. Then he can has the expectation, if the by chance share price increases, he has the option to convert into the share price shares. Basically that 90 rupees charge is because of two reasons. One, the coupon rate is more. Second would be that he has the option to convert. Now help me out in a data point, just general points now. What is my bond interest income? Bond, if I put my bond income, that would be 1000. How much percentage? Let's suppose if he would not have invested in this bond and he would have purchased the shares, how much dividend income he was getting? Dividend income, if let's suppose he did not purchase and instead of doing this he invested in the share, he was getting same 20 shares he'll get into what? 0.5. How much? 10 rupees. Extra income from bond is how much coming? Which I'll get is 40 minus how much extra you are paying by this bond? 90. Extra income you are getting is what? 30. 90 divided by 30 is known as premium payback period. 90 divided by 30 known as premium payback period. I'm using this data again, please. The data only represents is that if someone invests in the bond, if someone invests in the bond, he'll get 4% coupon, which is basically 40 rupees. If he would not have invested here, dividend income would have been 10, and he's actually paying 90 rupees extra to invest in this bond. The 90 rupees would be recovered by extra income of the bond, 30 rupees every year. That means this 90 divided by 30, which comes as 3 years, nothing but a premium payback period. Premium, whatever he has paid in how many years, it is this point comes. Want to copy the data, that's fine, else continue the premium payback period. Basically premium payback period is nothing but it's a in how many years increased income will recover your extra payment. Premium payback period. Can also be termed as a break even time. By chance he used the word break even time, so it can be also termed as a break even time. Paying 90 extra, with that you're getting 30. I've explained two reasons. First is why you pay extra. You pay extra for two reasons, because you get the convertibility option plus you're getting a higher coupon, and second is in how many years that would be recovered. They are interconnected by the engineers. Don't try to say much, everything will stop. What will stop from where we don't know. Let's come back. First part is asking new. Favorable income differential per share. Favorable income differential per share. Now, if you invest in the bond, how much coupon you are getting? 9% into 90. 90 you get from bond. From these shares, you would have got the one share, 1 rupee into 25. 25 into 1. Extra income, favorable income, divide by 25. Right? How much extra you are paying? Per share, if you ask you per share. I think you calculated here, na? 10, na? Another formula payback period I can apply is 10 rupees you paid extra, and every year you're getting how much extra? 2.6. The totality also I can do. If you look at, I can do by two ways. Favorable income differential per share is nothing but it's a coupon interest which you get on what you would have got dividend. Difference of these two divided by the number of shares. Coupon is giving you 90, 25 into 1 divided by 25, 2.6. That's one part. Premium payback period, one part is simply how much extra you paid per share and how much extra you get per share. That's one way of calculating. Second, what we learned formula just now was conversion premium divided by favorable income. That's total also I get. Favorable income difference also can. So either I can do per share. If I do per share, favorable income differential per share comes 2.6. Pay 10 rupees extra, divide by 2.6, gives you 3.85. Another way of looking at totality is the total extra you pay 1000 minus 750, I think 1000 minus 750, 250, divide by differences 90 minus 25. The 25 because one share is 1 rupee dividend is there, so if 2 rupees was there, it will be 25 into 2, so it's 55. That will also give 0.85 the premium payback. These two are new points which comes in almost every question. One formula has been given to you. If you want to copy the second one, copy this. Premium payback period is per share you can calculate, or totality you can do. Done. Now coming to the other part of the chapter, important. These two questions what we discussed have been commonly often repeated now. Duration, very important part. Not going into any depth analysis of it. We'll try to learn the formula so that comfort can come. Duration. Actually, different ways of doing could be done. Duration could be a time period in which a reinvestment risk and the price risk gets cut out each other, or there is a certain way of doing it. It's all calculus based formulas. From the exam perspective, way of doing is very straightforward. You can imagine the time period in which money would be recovered. So I'm covering a formula for duration with the help of an example only. Some small numbers. Working will learn. that the subsequent question working becomes easier for us. This is one of the common repeated question now because he'll move to the volatility, and then I think convexity, something new which they have been asked in the exam. You'll understand what exactly that means. Duration, price volatility, I will discuss separately that. Let's first learn the formula. Put down. Let's suppose face value is rupees 1000, on rate is 12%, life 5 years, rate 13, find duration. Face value 1000, coupon rate 12, life 5 years. Did this formula is WX divided by here. W is nothing but present value of cash flows counted ATM. Nothing but interest value. X is W is nothing but it's an intrinsic value. Value. Solution 5. Here cash flow present value at the rate if W 1, 4, 5. Cash flows are 120, 120, 112. Present value factors 885. 3 decimals you tell me. Point 69, 61, 54, 10.2, 93 point, 73.56. This is nothing but intrinsic value, and then you multiply 1 in. What is the total coming? 960. Will be total what? 106 point. 180, 249.48, 304.38. Three eight eight zero. 38 point duration. 4.0201 years. That means approximately your money would be recovered in 4.02 years. I've given you a couple of questions. We'll discuss that. Come to volatility. Along with that, let me do small volatility with you so that we can do both of them together. In fact, can I go back? Although generally I take some time before duration and then we move to volatility because that becomes a very cumbersome exercise. Now I would have given you handout. Immunization principle I have discussed with that I'll discuss with you later. Slide I gave you, I did not. Same example I used. Duration was a period here. Price volatility of a bond. Slide number 11 I am on. Let's read out the slide. Slide number 11 on price volatility of a bond. Now let's first understand the meaning of it. It says it refers to the sensitivity of bond with interest rate. That is, if interest rate changes, what would be change in price of a bond? Price of the bond would change for sure. There is inverse relationship between price and interest rate. That means if you look at this graph also, if I make you this graph, means if the yield rate changes, price will have a opposite direction. That's basically this graphical presentation. If the interest rate increases, the price of the bond will fall. If the interest rate decreases, price of the bond will increase. We need to find the slope of the curve. Diagrammatically it is shown below. Now the problem is, if you look at this data, I've just taken a rough number and I'll discuss only one method which comes very common in the exam. Rest methods I'll not discuss so that you will not get confused on it. If rate is R, let's suppose price is 940. If it's 8.5, increase, price falls down. If decreases, price increases. Actually, this is the perfect answer which you calculate by calculating intrinsic value. For example, if I give you 8% rate, I ask you calculate intrinsic value, you get the answer on the curve. If I give you 8.5, I don't know whether these figures are right or wrong, I'm just assuming. If I give you R 8.5, you solve 8.5, you'll get answer on the curve. The answers which your institute gives on the tangent. What he gives, I'll show you that question. What does it mean tangent? If you have any problem with the tangent, leave it. If you have not heard this term earlier, perfectly fine. This is my curve. A straight line, if we draw, which touches the curve, is known as a tangent. Now when you stand here, intrinsic value when you calculate, that is one price. Now this is one price at this yield rate. Now let's suppose institute says calculate the modified price, and when I modify the prices, basically actually I'll be using some called modified duration, which I'll come you volatility we call it as. I'll come back to it. He'll ask you to calculate some volatility function. He'll say if the yield rate changes by 2%, what is your change in price? If the yield rate changes by 3%, what is the change in price? He'll ask you some concepts on that part, that what is the change in price. Whatever answer he gives, that answers comes basically on the tangent. For example, if let's suppose yield rate changes and I try to draw an answer, the tangent will give me answer here, the curve will give me answer here. Maybe if this is my curve and if this was my yield rate, there could be possibility I might have answer this way. If let's suppose the rate decreases, price increases, it falls answer here and the curve gives me answer here. What we get the linear relationship answer on the slope of a tangent. We find slope, etc. These words technical I'm using, no need to worry on that front. It simply is whatever answer you will find. For example, if 2% increase, 2% decrease give, if you use a general concept which I'll be using just now, I'll be using very shortly, that answer would be on this tangent, a straight line. Actually, the relationship, if you look at, increase of 0.85 and decrease of 0.85 will never lead to equal increase decrease in the price. When they do not lead to equal increase decrease in the price, the relationship is perfectly based on slope. We called it's a slope curve because it's a convexity. It's a convex to the origin. And if I say 0.5 upside, point downside, and there is an equal movement upside and downside, that comes on the straight line. So some answers came on the straight line which are valid for the exam when you calculate, which I'll calculate now. Some answers are curve. Curve is nothing but as good as intrinsic value. Third part could be difference between that curve and that slope. So if we look at this difference between this curve and slope, that's called convexity. So we have to find out that also. I'll not go into very lengthier mathematical equations because that involves derivative of first calculus, derivative of second calculus. We'll try to learn something very general way what exactly. So these are all calculus based formulas. The derivation was so fitted in well that the answers comes very nicely. So when you find convexity, or when you find the curve, when you find the tangent, basic purpose is tangent gives a linear relationship. Slope of a tangent is nothing but modified duration, and slope of a curve is nothing but it's a convexity, curvature we have to find. So we can find both of them. No need to worry on that front. You'll be able to remember it out. I'll give you some logic of it. And at least out of the 5 parts, 4.5 parts we will able to do very easily. And we should know that answer is falling on curve or tangent, so that when you look at the answer, you can take a justified decision. Although this topic I generally cover in a very large time, but since we have a scarce time, so I'm combining the questions. I'm not taking break. Otherwise, we do duration, we practice duration, then we do immunization. Something. Well, I have my own way of doing it. In this, I am merging it together. The complexity will come accordingly. Question will be framed accordingly. Let me check out the questions first. Question number 19. Read out question number 19 once. Read out question number 19. If I read 19, it says, following are the data available for a bond: face value, coupon rate, years to maturity, 1000 redemption value, YTM 17. What is current market price? Duration. Volatility function formula, I'll just tell you, that is, you can write volatility or a modified duration. Volatility is equal to, which is from the exam perspective, one plus YTM. How do we read? We'll read, don't worry. You can call it as a volatility or modified duration. Modified. Now let me look at the answer, and then he says calculate the first. Let's try 3 points till volatility. I think I would have given the answer. Let me check in case it is. Yes. Look at the first part. 19. First he said calculate is the current market price. It's nothing but summation of present value of interest plus present value of redemption value. Present value of interest is 160 into annuity factor plus 1000 into present value factor. We get 964.24. That comes our intrinsic value. Now second part he asked is duration. Duration is same way what we have done just now, the calculation. So I'm not doing it here because one of the questions has a lengthy duration calculation. We'll do in the class. 1, 2, 3 sorry, 3, 4, 5, 6. Cash flows 160 present value factor. PVCF will come exactly same. This is nothing but intrinsic value. WX will come 4091. We get 4.24. that is not, no problem will come. Then basically I have volatility would be duration divided by 1 plus YTM. It's duration. These are all calculus formulas, so do not try to read in a general layman's language. Way of reading will become slightly different. 4.24 divided by 1.17. How much do we get? 3.62. Now 3.62 is read as if the yield rate changes by 1%. If the yield rate changes by 1%, the price will change by 3.62 in opposite direction. If the yield rate changes by 1%, the price will change in the opposite direction. If the yield rate increases, price will fall. If the yield rate decreases, price will increase. When I use this language, I am using a linear language. It is the tangent function. So we are using a linear function, that means I am using a tangent. Answer is valid for the exam, 100% valid for the exam. He asked volatility, you calculate this volatility and you say if the interest rate changes by 1, price would change by 3.623, 3.62 or 3.623. The price, the relationship of the yield rate is in opposite direction. He says yield rate increases by what percentage? 75 basis point. If the yield rate increases, price will fall 2.717. This comes 938.04. That means, sir, will this fall on the line, straight line, or that curve? It will fall on the straight line. This will fall on the straight line. When you use this linear relationship, that I am standing here and I am saying if this changes by this, because I am not bifurcating, the movement upside and downside cannot be a straight, it has to be curved in nature. When you use a straight, that means, is it valid for the exam? Yes. Somewhere you might find the answer coming as 934 point something or 941. I don't know which answer will come. Some answer will come differently. So there could be some possibility answer might come slightly different. That answer will be on the slope. For the exam, these are valid answers which comes out. So that's a valid answer which comes out. Second question, which is exactly based on this principle, is I want to try is 45th. First part, second part, third part. First part, second part, third part. Try that out quickly. The following data is available for a bond. Face value 1000, coupon rate 11%, 6015. Current market price of the bond. Current market price of the bond should come 848.62 or 24 I am getting, you can get 6. Duration of the bond I am getting is 4.58. Let me put down third part answer. Volatility. Valuation divided by 1 plus YTM. How much is duration we have? 4.58 divided by 1.15. How much do we get? 3.98. So how do we read 3.98? What you can put down? If the yield rate changes by 1%, then price will change by, right? Now fourth part, he said yield changes by what? Increase or decrease? Yield rate increases by 100 basis points. 100 basis points is as good as 1%. 100 basis point is as good as 1%. Implies price fall by what? That will be 848.24 minus 3.98%, and answer will fall on the curve or tangent line. It's a straight line relationship. How much do we get? 814.48. Fifth part he is asking what? Yield rate decreases by how much? 75 basis. 100 basis point is 1%. 0.75 implies price increase by 0.594 985. New price. It's 48.24 into what? Or plus, you can do plus 2.985%. How much do we get? Upside downside, a linear relationship is a line, straight line. Done. Now let me move to, if you've done, let me know. Now let me move to game convexity. In exam which came you will not have this question in the, you will have to refer my book only. November 2020 paper. It's November 2020, I think. Now look up please once. This question came in exam. When the question comes in exam, first reaction comes. It says face value 1000, redeemable part, maturity coupon 8.5, years to maturity 5 years, YTM is 10, full stop. you are required to calculate current price of bond. Can you calculate? Asking. Morley's duration. Duration we can calculate. Volatility, convexity, we do not know. Now also let's suppose we do not know. Expected market price if there is decrease in YTM by 200 basis point by Morley's duration. Basically Morley's duration helps in volatility, and volatility helps in what? That volatility helps in finding a what? Change, linear relationship. And second by intrinsic value. That means if the yield rate YTM decreases by 200 basis point, whatever new YTM comes, new YTM would be what? Is given as YTM as what? 10 na? So new would be what? 8 percentage. You can find intrinsic value. You can do. First reaction comes, oh, we don't know convexity. How will you do this question? Leave choice. Now like if it's a 10 marks question, at least 8 you can comfortably get. If you do not know convexity, leave it. Just telling you the reaction. Actually in exam I don't know what happens. In exam one part. Don't know. Actually rest of the part which are straightforward na, that also we do not do. And in that reaction, it's a normal reaction. I don't know why it happens. In exam, you assume something will come differently, which you would not have even tried earlier. Could be a possibility. At least in one of the papers will come. Or any paper when it comes, then leave that out. You do not have to score 100 out of 100. I'm again and again saying, in class also I say, if you attempt 90-95%, it's more than enough. To target a 70 to 80 percentage, that's more than enough. Be specific about it. Do not overestimate. Somehow you start assuming if 100% paper I have not attempted, I have made a mistake. It's not that you cannot attempt. You can attempt easily. But sometime if let's suppose this came, and even if this comes, I do not know whether I will be doing calculations right or some other formula right. So if it has, let's suppose 5 part, it comes to 8 to 10 marks, there could be possibility highest is 2 marks. And interesting, it will not have any link with any part. If there is a link of the part, then I can imagine one part I do not know, the subsequent part has a problem. So first my target goes is, let me try whichever points I know, let me solve. Then I'll see, check for the convexity which comes out. This actually will do what convexity? He will check out the answer which you get on line chart and the answer which you get on curve. The difference of that is a convexity. Now interesting part is, when you calculate by intrinsic value, you get answer where? Curve. If you calculate on modified duration, tangent, that means modified duration plus some adjustment should give me the answer on the curve. That is called convexity. Roughly the answer will come same in exam. If anything happens, difference of these two in amount term is nothing but the convexity. But somehow your institute is smart. He did not ask that. He asked the percentage. We'll check it out how to do it. But interesting part is nothing but if I try to show you, let me show graphical presentation. Let me show. That means basically if I show you the difference, what comes, whatever the answer will come. Let's suppose my intrinsic value gives me 10,204 and my tangent gives me 10,160 at 8 percentage. I am falling here and I am intrinsic value or this answer comes here. So I am trying to find that difference. Interesting part, if you try to watch, will be the tangent answer in the straight line. Actually, if you look one more thing, if you look at one more thing, the straight line is always lower than what? Curve. That means curve will always give you better answer. When it increases, higher answer. When it decreases also, the answer is much higher than that. So it gives you straight line relationship is avoided. Let me try one by one. Every part will try. Since you do not have the answer also, we'll try in your own way. Let me clean out the process. Assume as if we are testing ourselves now. The same question came in exam. Bonds is something, a technical complicated topic. Whatever is required is more than enough, because you cannot become a mathematician. You cannot learn the theory, because this will have some function of change in yield rate to the part 2. That's a second calculus. So we cannot imagine to learn. I cannot expect you, because I am 99% sure 90% of you would have left the differentiation integration in the foundation also. And you might not have known what is the use of that. The use of here also, they do not tell what is the use. Even if they tell me the use, when I become a chartered accountant, it's I'm saying very frankly, 99%, 99 100% at least I know. Even if I am valuation side, calculus I am not using. If you are in the income tax side, I don't know whether in income tax you use calculus or not. But institute wants you to learn everything. and everything. For teacher it becomes very easy for me to say, oh, this formula you should know because you've done calculus in the foundation. Under the sun everything would be there. That does not mean that you'll keep learning everything, but for the exam there is certainty. If any new point comes, it's okay. If anything comes repetitive, by hook or crook you should know. And I'm saying you again, bond valuation is a mathematical exercise. Some of us, we have to be good at commercial mathematics. When I use a word commercial mathematics, that means I should be able to read numbers. When I say compound amount, normal rate of return, if this growth comes, then what is the value becomes. If this growth comes down, what is the value becomes. These are commercial mathematics. I'm not here to become a technician, derivative, or this angle will come, this will come, this angle will curve. For example, some of you might be wondering what language he is using, tangent curve. I have to show the knowledge now, so I have to use tangent curve. Tangent curve is nothing but a straight line answer comes. You've been getting that answer also, that straight line. The same thing if you have to get curve. The simple word was, why ask a convexity? Tell us calculate intrinsic value. That is on the curve only. But he'll ask you this way, curve, tangent, and then he'll ask difference also of these two. Otherwise, you ask me where do you want the answer? He says straight line. I'll say upside 2%, this answer, downside 2%, this. He says curve, I'll calculate intrinsic value. But somehow mathematicians have the tendency of using that mathematics. At CA, I do not assume that these complexity will come in the practical life, provided you are in the core accounting or even the finance side, but not in the valuation of the bonds. If you go in the valuation of bonds, then certainly you have to study something else. Let me come back. Let me come back. The following data available for a bond. Face value 1000, redeemed at a par maturity, 8-point coupon, 5 years, 10%, and rates are given to you. Do not use your own, please. I am using 0.909, 0.826, 0.751, 683, 621. Current market price of a bond. Let's find out. So find out current market price of bond, intrinsic value of bond. That will be 850 into annuity factor plus 10,000 to present value factor. How much do we get? 9431. This is the answer we get, na? 9431.5. 9431.5. Then second part is duration. Duration. Let's calculate first, second, then duration. Duration would be, I have second part duration answer as year 1, 2, 3, 4, 5 cash flows. Present value factor at the rate 10%, PVCF, WX. Then my duration is 4.25. Fine. Third, volatility also calculate. 3.865. Which one? Not love, I like to. They have said or not, I don't know. They'll consider everything. How many decimal they have used? They have used 3. First they have used 1 decimal, then they have used 3, and then they have used. It's perfectly fine. Generally they will write, if they have not written, it's okay. Nothing is written. 2 to 3 decimals. That's fine. 4.25, 3.87 or 3.86. Answer will come in rounding off no matter what you try. 4.25 and 3.87. Then I'll not do fourth point, I'll do fifth point first, which I'll show you. He says in the fifth point, let me go back. In the fifth part, he says expected market price if there is decrease in YTM by 200 basis point. That means new YTM will become how much percentage? 8%. Use volatility, that's volatility modified duration formula and new intrinsic value formula. 8% annuity factor, if someone can tell me. 8% annuity factor. 3.993. You do not use a calculator, add these factors: 0.926, 0.857, 0.794, 0.7315 and 0.68. 3.993. Now it means I have written it here. The expected market price if YTM decreases by 200 basis point, Mockley duration, that means, and there are 2%. Don't make a mistake, 2%. The 2% is 3. It was 3.865, so I have used here 3.865 into 2, 7.73, and then you have new price would be 9431 plus 7.73. This answer will fall where? Tangent. I have written here, it's a straight line. The answer which you will get on intrinsic value, you have to be mathematically sure at least that answer would be higher than 10,160, because the answer on the curve would always be higher, because curve and tangent touches the line, the curve at a single point. The tangent answer would always be lower than, no matter whether the yield rate is falling or yield rate is increasing, nothing of that sort. Its tangent is this intrinsic value at 8%. Just simply multiply that annuity factor into the intrinsic value formula. You apply a summation of present value of interest plus present value of what? Redemption value. I'll get some answer here, 10,204, and this will fall where? Curve. Now let's suppose I do not know convexity. So at least till here there was no problem. This was in fact one of the simplest question I could have assumed if ignored the convexity. Now since we know the convexity, we can try out the convexity. Actually what has to be done is, in this tangent I have to do some adjustment, and that adjustment is called convexity, such that answer becomes this. That convexity has to be done. I have used the same notation what your institute has used. Otherwise when we do some like a modified duration, we have some other duration formula. When we use volatility, I do in different way in the regular class, which is not there for you, neither required. We use P2, P1, P0 summation. Accordingly I have taken the terms he has used, I think V plus, so I have kept those terms. Otherwise we use differently. Let me go back now. The convexity, what we are trying to do basically is, if you look at this graph, now in this case your intrinsic value is coming on the curve as 10,020, 4 point something, na? That's fine. On this it is coming as what? 10,160. This is coming as. Now convexity, what the function he has given is, actually he uses, this is a calculus function, derivative of second, the C star into change in yield rate to the power 2, twice. Change in yield rate is 2%. This C star is, it's V plus, they have used this symbol. I could have used, instead of V plus, P2, P1, P0, since they have used, I have used exactly same. This formula is nothing but actually what this formula is doing is, this formula if I try to see, it's actually a combination of the, if this is P0, let's suppose original price is P0, some price will, when you decrease price will go up, when you increase the yield price will fall. So we are basically changing the, seeing the changes in them. That means P2 minus P0 divided by P0, P1 minus P0 divided by P0. When I combine them together, this formula actually comes out, kind of this formula. And since it's a derivative of second function, it's a delta y in change it comes. So when you multiply C star into this, something would come. As of now you might not be able to appreciate what exactly it is coming. When we get the number, we'll get that this will come, this will fill the gap between this tangent and this part here. So basically if you look at here, V plus, actually if you try to, I try to decode the formula, it's a V plus is the value at the lower rate which comes a higher value. We generally call it as a P2. It's a V plus V minus 12%, that is V minus, this value is V minus, I've used the notation what you need, minus 10%. So what we try to say is, if I am standing here and if this is the value, we say from here, if this is our original value at 0, then what are the values, this value 1, and how much is the change coming here, this value. So change from here to here, change from here to here. These two formulas are showing the same thing. You combine them together, it becomes V1 plus V minus. V minus is value at a higher price, 2V0 divided by 2V0. Since double, it's a change in the calculus function, change R which comes out. What we get here is at least two values we have already calculated. One value we calculated at what rate? One value we calculated at 10%, which was 9431. Second value we have already calculated what? 8. So change is not there. Remember in the exam, whatever change you are looking at, change should be equal. Change should be equal, either 2 plus or 2 minus. Since already you have taken 8 and he has given indication, so next part I have taken 2. Instead, sir, instead of this, can we take P2? If this is my P0, I can take, if this is my P0, I can take this is P2, I can take this as P1. P2 minus P0 divided by P0, P1 minus P0 divided by P0, and accordingly I try, half of the function is already built up, and this is because of the calculus part which comes out. So I'll get some number, just see the value at 12%, do you get 8734? 8734. Calculus, sir, tell us the annuity of 12. Annuity factor at 12% is equal to, how much do we get? 3.605. So basically, how do we get this value, sir? What was the interest? 850 into 3.605 plus 10,000 into 50 year factor 0.567. This should give you this value. Check once. This answer is coming where? Tangent or curve? Curve, na? Let us do one more exercise before I come back to this so that you get more comfortable. Look up, please. Look up. If I draw my chart, if this is the curve, what was my original price? Let's suppose. What was your original price? At what percentage, sir? 10%. What was the price? 9431. Something 9.314. Then let's 2% we decrease now. 8%. This price came what? 10,204. This came 10,160. Now what we are doing? I am just check you price. Something more I have calculated. 8% and 12% intrinsic value calculated. What price came? 874. Try to find on the tangent that would come lower than this. Try to find on the tangent. How do we find tangent, sir? What was your volatility coming? 3.865. So 1 point you increased by 2%, now you decrease, that is 7.73 na? 7.73. What you did, how did you calculate, sir? 10,160. 10,160 was 9431.4, I think, plus 7.73. So straight line would be 9431.4 minus what? 7.73. How much will you get? 0 to approximately 870, 2 or 3, something you will get. Now from the curve, first understand the basic part of it, that curve is always an investor friendly. Curve will always give you the higher answer. And linear relationship means, you should also get linear means 7.73 plus or 7.73 minus. Although he did not ask, this is just I am telling you so that you get difference between the curve and the tangent. Now the answer is, we need to find basically that difference between the curve, convex. It is called convex because it is a towards the origin, it is a convex shape. So because of that mathematical function it comes. which is not required. What we want is, if I using modified duration from 9431, can I reach at 10,160? If I reach at 9431, this was nothing but my original intrinsic value. Then you did what? Normal volatility, you said. Volatility was nothing but 7.73. You said since the yield rate is falling, the price will increase by 7.73. So what you simply did was 9431.4 plus 7.73. You reached where? 10,160. So you have already reached the tangent now. Now what has to be done? We need to find that additional part so that answer can reach where? The curve. That is called convexity. To reach that, we are seeing if upside and downside do by equal amount, I reach at 10,160 and I reach at what? This 8702. And on the curve I get 10,204 and 8734. So that means my value which comes, and the intrinsic value which I get is P2 or higher value is nothing but 10,204 plus 8734 minus 9431.5 into 2 divided by 2 into this into 0.02. I get 9.93. Now I cannot read this 9.93. C star was nothing but C star is equal to delta change in yield rate. How much yield rate we are changing here? 2%. This comes, if I, two ways of putting the answer. Two ways of putting. One is 0.003972. Second, if I multiply by 100, it comes 0.3972. Now answer will end here. Maybe the books will answer. I think book has ended the answer here. But what does it mean actually? They have ended the answer here only. Convexity 0.395. We are getting 0.392. Now what does it mean? Let's try to read. I have done some number work which you can avoid in the exam. That's basically an extra adjustment over and above modified duration. What you can do is, you this part you already got from where? 0.0773. You got from where? From the modified duration. If you add that something extra, that this you basic change has to come what? 8.1272. Modified duration gives actually a linear relationship. In that linear relationship, I am trying to add something additional. This gives me that something extra, and that something extra when we add, so we basically say 9431.5 plus 8.1272, I'll reach approximately 10,198. That is exactly what it is. If you want to copy, I'll just show you one by one, and then I'll show you the convexity also here, that function. First you do one thing, just write this word, write this part here, convexity. Modified duration, this assumes a linear relationship. Modified duration, this assumes a linear relationship. We need to adjust for curvature. We need to adjust for curvature, and that leads to convexity. That leads to convexity. Then you can multiply C star into change in y to the power 2, or into 100 you multiply. And those who have done regular or done the classes earlier, at least from me, they can write the terms as P2, P1, P0. When you go back home, you'll be able to recall back with some other concept. P2 minus P1 by P0, or P2 minus P0 by P0, P1 minus P0 by P0, and that formula you'll be able to easily recollect. I don't know why I'm feeling if any smart teacher is making paper MCQ, he'll ask a simple question. Answer will always be better off for on curve or tangent, or for the investor's point of view, the beneficial position. What gives a benefit? Curve means the convexity is investor friendly. Basically convexity is a friend of investor, because answer on the curve will always be better. Whether the yield rate changes, no matter what size, curve will always be above what? Tangent. I don't know how we'll frame the question, but basically curve answer, I showed come somewhere na curve. Once you copy that, I'll see. The curve answer would always be better than, I have made it here. The curve answer will always be better than the tangent. Whatever questions you will be doing at home, maybe when he says calculate intrinsic value, if you've copied this, I'll show you the graph. He'll say calculate intrinsic value, then he'll say calculate duration, third he'll say calculate volatility. These three are common. Fourth he'll say change in yield rate. What is the change in the price? Answer as per the line, straight line. Do not try to learn this convexity. Convexity is when he is asking straight. Two things he can ask. One, he is asked this here. Second, can ask is what I've shown in the seva part, that once you reach plus that convexity, you can reach on the curve. So basically, another point which can be there is the from using a modified duration will lead me from intrinsic value to the tangent straight relationship, and then convexity can be added. Unless and until he is using a word convexity, please do not use that word. So leave the answer as per tangent, but you should know, because MCQ could be straight, very common, that when you apply 2% change, whether we are getting the answer on the line or whether we are getting the answer on the curve, you should be very comfortable now at what we are getting from here. So my answer which comes out when I say basically is, when you get answer here, this answer you can leave the answer here in the exam, or you can leave in percentage here. What you say is that extra adjustment over and above modified duration. Modified duration led you to reach at 7.73. You have done something extra. That extra will lead you here. The difference is coming because of the rounding off. If you can recall the formula from P2, P1, P0 divided by 2 P0 only is into change in y to the power 2. Actually, that can be made slightly complex also. It's done. This was November 2020. When you go back home, you can refer back your books, notes, able to get. Remember a rule that change you have to assume equal. If you are moving 2% up, that 2% down. We have kept 2% because he has given 10 and 8. So I have assumed second as 12. 12 was not given in the question. So what do you mean? He actually gave us these two rates. He gave us 10 and 8. 10 was anyhow required. 8 basically change in 2%. So since I calculated 2% decline in the yield, second I have assumed 2% increase in the yield rate. Let me know if I can move. Then I have to move to the immunization principle. That is also something very interesting. I mean, it has been asked. $7.73. So how did we get that? Was using a volatility function. Can I move? Let me go back. (46th). This question you would not be able to realize whether it was an immunization or not. Something called immunization, where duration of asset should be equal to duration of a liability. The second time when this kind of question came, he explicitly asked that how should I immunize my bond. Immunization is, I should be investing in my assets in such a way that as and when the liabilities arise, I am able to take care of my liability. That's called immunization principle. So this was based on that. It was general question. We do not even come to know while doing it whether it was an immunization. But second time when came, it was a very lengthy question. Very lengthy. 10 years duration, 8-year duration, 5-year duration. And then based on that, he applied a immunization principle concept. That will be clearly, you will be able to visualize what is called immunization. Immunization means a duration of an asset should be equal to duration of a liability. That means as and when the liabilities arise, you are able to take care of the liabilities. Read this question 46. Read out question number 46. Try out then. Let me read out. Sorry. This Mr. A will need rupees 1 lakh after 2 years. He will need rupees 2 lakh after 2 years means it's a liability for which he wants to make one time necessary investment now. Will need 1 lakh after 2 years. They want to make a necessary investment. He has choice of two types of bond. Details are as below: bond X and bond Y. Face value 1000. Coupon 7% payable annually first, 8% payable annually. Years to maturity 1 and 4. Current price this. Current price is given 10% rate. And advise Mr. A whether he should invest all his money in one type of bond or he should buy both the bonds. If by I will apply some weights in that weightage. If the weightage comes proportionately to two of them, to say invest in both of them. If by chance one comes 100%, automatically 100%. If so, in which quantity? That we come to know, don't worry. Assume that there will be no callable or default risk. Default is not there. Now what has to be done is, this is called a duration of a liability actually, and he has selected two assets. These are bond as an asset, because you generally attach bond with the liability. So basically he want to invest in bond X and in bond Y. He want us to understand from us, should I invest in one bond or should I invest in both the bonds? If I invest in both the bonds or single bond, how much should be the proportion? Since first is a 1 year bond, so we calculate duration of this bond would be 1 year only. That's 1 year. Then bond Y indirectly is 4 years. We'll calculate the duration of Y and we'll multiply average of this into average of this should be equal to duration of a liability. Duration of a liability. Basically, these are my assets. These are my assets. I need to invest in either one of them or both of them in such a proportion so that as and when my liability arises after 2 years, the average of these two should be equal to 2 years. For example, let's suppose, I'm just assuming, if since this is a 1 year bond, duration of asset will come 1 year. That means this bond will give me money back in my 1 year. Let's suppose this average comes, I'm just assuming, let's suppose this comes me 3.5. This is equal to 3.5. What I want is the 1 into some weight plus 3.5 into some weight, that will be weighted average asset. That should be equal to what? 2 years. That has to be equated. So this was actually, when this question came, no one even came to know that it's an immunization principle. This is an immunization principle in which duration of a liability should be equal to of a asset which comes out. Let us try that out. What we'll do is, let me. Next question we'll do completely. This question I'll do slightly faster way. Let me look up please. The next question is very interesting, lengthy question. Sorry, it says 46. We have liability will arise in how many years? 2 years. DL is duration of a liability. Duration of a bond X, since it's a 1 year life, we have a 1 year life period. Duration of a bond by, the money would be recovered in 3.56 years. How did we calculate, sir? I be calculating using this part here. This was not straightforward given. So what you do is, he has asked you duration of Y, 1 year, 2 year, 3 year, 4 year. How much is the coupon? You have 8%, na? 880, 80, 80, 1080, and then you have present value factor at what rate? 909, 826, I1 this, and you get PVCF. I think PVCF would be same. That's why the 10% I have used. It's same which comes out, and it's 33335.68. So we get 3.56. Now what we want is, I have just substituted this value here. That means my asset A, bond A will give me money in 1 year. My B will give me 2 years, 3.56 year. I have assumed let the weight of X will be WX. Total weight is 1. So Y would be equal to 1 minus X. Duration of asset is X into weight X, Y into weight Y. And I get the duration of asset as this 3.56 minus 2.56. Then applying immunization, he did not use, I am using, and now 100% you can use, because in the recent questions he has started using this word. Applying a immunization principle, we say duration of asset is equal to duration of a liability. Duration of a asset is equal to 3.56 minus 2.56 WX, and liability arises in 2. When you solve this, you will get weight of X is 60.94 and weight of Y is 39.04. So first answer he asked was, should I invest in both the bonds or single bond? So answer comes, invest in both the bonds. Then basically what quantity to amount to be invested now? Now 1 lakh rupees I require after how many years? 2 years. Timing wise, if I say, if I require 1 lakh after 2 years, present value of liability is 82,600. 82,600. If it is 82,600, then amount to be invested would be equal to 82,600 60.94 in bond X and 39.06 in bond Y. The number of bonds to be bought, these values are arising in what period? In 0 period. So 0 period, this value divide by the price which we are standing now, 972.73. Approximately buy 52 bonds of this and buy 34 bonds of this. In the regular class we would have done, before this I generally do one example in which I prove also that how exactly this duration of liability asset comes. So we do not need to prove here. When you go back, you can check your notes in which you will find that you have taken an example in which create a liability and then accordingly create an asset, and that asset systematically, sir, how will happen that as and when the money would be required, when you solve this, you will get the money in 2 years time. So that becomes your duration of asset liability. This did not mention explicitly about the immunization. Next question which came, he explicitly mentioned immunization, but that question was very lengthy. I would have asked if anyone would try at the last, reason being because if your first part is wrong, then subsequent all parts would be wrong. And first part is 10-year duration. Somehow I did not like that question, only from the perspective that how can you ask 10-year duration, second 8-year duration, 6-year, means more than 45 minutes, half an hour will go there only. But he has asked in the exam. Next time I am assuming this was justified enough, that means he gives a smaller part and he can ask you, or he could have given some easy numbers and could have asked the question. Let me try that question exactly the same way. Let's look at that question number. Answer is given but will not see from the book, we'll try on our own. Question number 55. A very interesting question set in the exam. In fact, this can be one of the questions for the case studies if you want. Could be there for the case studies. First, he can 20 marks case study can come. Instead of 3 parts, he can make 5 parts. 5 parts he'll make. First part duration of A, second part duration of B, third part duration of C, and then second and third part each he can give you. That could be justified. There could be a possibility this could be a kind of a case study which can come. The question 55 in your notes also. The following data are available for 3 bonds ABC. These bonds are used by a bond portfolio manager to fund an outflow schedule in 6 years. Actually, this is the exact reason. The portfolio manager wants that, he knows that there could be a pension fund out also. There could be a portfolio manager, he knows there will be outflow after 3 years, 4 years. And we do not know how the fluctuation will come. He wants to immunize himself in such a way, no matter what the interest rate. I am not proving it here, otherwise proof is no matter what the interest rate becomes. And we can immunize ourselves in such a way that whether interest rate goes up or goes down, whenever the liability arises, I have the amount ready for me. That's it. That's basically a pension fund managers do it. So he has taken the word fund manager, portfolio manager, to fund an outflow scheduled in 6 years from now. Current yield is 9% and all these bonds have face value of 100 and will be redeemed at par. Interest is payable annually. One has 10 years maturity, that means you'll just 8 years, 8 years, third is 5 years. Calculate duration of each bond. You have to calculate quickly. Duration of, I just want to see how much time it will take. This question thoroughly you can do. It will help you revise major part of immunization plus the duration 10 years. The 10-year duration, how do we do? This way 1, 2, 4, 5, 6, 7, 8, 9, 10. Cash flows, cash flows, cash flows, cash flows. Factors also in book he has given. Apply the factors, get the duration. Calculate duration. Done. First, second one. Duration of first year bond is coming 6.86. Second one, I've tried to use my time by just writing cash flow B. 11 coupon, I think. Is it 11? Yes. 11 coupon you have. 11, 11, 11. These are 8 years. Then you can do what, sir? 11 multiply by the present value factors. Factors are same. Just give some space here. It comes 5.83 and then by 5. Now why I'm asking you to try this is I could have avoided it. Only you should know that if this mistake, any mistake is made in the first level, because subsequent all parts are linked will make a mistake. Unlike that question number of convexity in which linkage was not there. You have to smartly play in the exam that which question if I have to leave, I have to leave. If any link is there and you think length is too huge or there could be some problem in the initial part and which has linked to the subsequent part, try at the last. The question number previous one which we did convexity would have given you everything perfectly fine except that part. And I certainly have no idea under what mindset examiner creates this kind of question. No idea why he creates. I think institute should be giving them extra money to solve paper first and then set the paper. They'll come to know automatically, because unless and until you try on your own, you will not to come to know what is the problem. You ask me, it's a pure labor work. Pure labor work which you do. Look up once. First part you were doing now? First part. How many years data you had? 10. Let's suppose I stand in January 2020. Just it's taking time, otherwise duration what you are taking time, it will not take more than 30 seconds time if I was doing with the proper laptops. 10 years means 20, 21, 22, 23, 24, 25, 26, 27, 28, 29. You've done 8 year also, na? So this will be 8 year. What was the coupon rate of 8 years? Coupon rate was 11. 11. Yield was? Yield was 9%. What is your answer coming? 5.833. This is the answer coming, na? 5.833. Now let me change. This is exactly time it takes. It is taking me more time because I don't have the option to play with this because mouse etc. Now the second part, what you had? How much was the coupon in the first part? 10. 10%, na? 10. Wait, Nalayak, not habitual of this. 10%. And the yield rate was 9. And let us change this here. Let me make 29. How much answer you were getting? The duration formula. Now this is pure labor work you're doing. I'm saying you. I have to show you. I don't have the other option. This examiner should know. He should know how practical duration is calculated. Now this is not the examination pattern in which you start giving 10 years. Practically it does not take more than 10-second time. Just put the data. Duration is equal to, even you can go back and learn what comes. It is not rocket science. I have learned that here only. The opening date, settlement date, coupon rate, yield and frequency. If I divide frequency also, answer comes. Same formulas we can do. We can draw a lot of charts also. Means everything we can do in general classes, in normal classes we do. But anyhow, I just wanted to show you that exactly what does it mean. That means you're doing a labor work. You have to accept it. In exam, you have to take a very calculative call. If by chance you find any question which are lengthy, then try to save your time. At least do logical question and score the marks. That was just a duration. You can change anything and answer would come. Just change the number of years, answer would come. This part. Now coming back to our question, this 6.86, 5.83. Third one is what? 4.24. You got now. Now I expect them to give you these number and then ask you second, third, fourth part. It becomes one of the beautiful questions. If they give you this part and then ask you the second, third, fourth, it becomes one of the very beautiful questions which in the exam. Second part he says, I am assuming that every one of you are getting the same numbers. Duration of A, that means asset A I am getting 6.86. Duration of B I am getting 5.83. Duration of C I am getting 4.24. These are the durations which I am getting here. Now let me come back to the second part. He says, second part if I go, which was basically says, the bond portfolio manager has been asked to keep 45% of the portfolio money in bond A. That means weight of A, he has already decided what? 45. Calculate the percentage amount to be invested in bond B and C that need to be purchased to immunize the portfolio. That means duration of asset should be equal to what? Duration of a liability. And first line he said liability will arise in how many years? 6 years. So can I put my, let the weight A, you know A already he has selected now. 45. Leave that 45. Balance has to be between what and what? B and C. Let's suppose in B he invests X. In C how much he'll invest? 1 minus 0.45, that is gone for whom? A minus X. That is basically for C. So when I apply now that, because 45% is for A, so it is for A, B has taken X, balance is for C. Answer will come 0.55 minus X. Duration of A would be, you got some duration 6 point something into 0.45 plus B into X plus C into 0.55 minus X, that should be equal to what? 6 years. When you solve, you will get the weights accordingly. So what we need get from second part is, what we get from second part. Look at the second part please. Let weight of bond A given in the question 45, weight of bond B X, weight of bond C will be 0.55 minus X. So duration of asset would be equal to A into weight of A, B into weight of B, C into weight of C. 6.86. This sir, how did you take this? Actually I have taken the liability. I have compared here only. You can calculate the asset and then compare with the liability. 6 is not the asset, it's a liability, and since we are immunizing, he is clearly using that word immunization. It has to recover in how many years? 6 years. So this into 0.45, this into X, this into this should be given the 6 years, and I should get bond of B and S. This was slightly interesting, and the wordings also used properly. Immunization principle. Otherwise, we generally don't find using these words immunization at all. Those who got the hint for the second, third, try on your own, third part. Third part, let me try out what he says. Third part, he says, after the portfolio has been formulated, interest rate change occurs, increasing the yield to 11. The new durations are A 7.15. He would have done something and then he recalculated. He has calculated 7.15 duration of A, bond B duration 6.03, C bond 4.7. Is the portfolio still immunized? So what does it mean? It means use the weights which you got just now, multiply by them. If it comes equal to 6, it means the portfolio is immunized, else it is not. Basically, using these durations and the weights which you calculated in the part 2, multiply by them, and when you multiply by them, basically you will get something. So you will get as new duration of the asset, third part, that's basically 7.15 into 0.45, 6.03 into 0.6354, 4.27 into 0.1846, 6.209. The portfolio is not immunized since duration of the asset is not equal to what? Of a liability. If it would have come equal to 6 here, that means you were immunized. So basically said there is a change in the duration of the asset which has occurred. Because of the change in duration of asset, if it is coming equal to 6, you are immunized. Since it is not equal to 6, you are not immunized. Try the fourth part quickly. Try the fourth part. This determine the new percentage of B and C that are needed to immunize the portfolio. Bond A remaining 45% of the portfolio. So basically, again you have to find what new. It's continuation of a C part, duration of a C, and weights accordingly you calculate. This would have been an interesting question if provided first part was not there. He could have asked in the first part exactly same way third. Things would have been easier, or he can create at least a 3-4 years duration. That's much better off instead of giving 10 years, 8 year, 5 year. It becomes a cumbersome exercise. Done. Now one more question which different type of variety can ask you. Have I given you 66 once? Try to look at. These are repo transaction which are short-term lending and borrowing. One hand securities will be given as a collateral and then interest would be calculated. Someone who needs the money and someone who has ample money with him, they will lend over a period of a time. Short-term borrowing and lending, but they will include some term dirty clean price. You might have done in the accountancy, I think, clean price, dirty price. Pricing of the bond will take. So what is dirty price? Dirty price is clean price plus accrued interest. Actually, what happens practically is the coupon, for example, if I stand in zero period, 1 year, 2 year, 3 year, if there is a 1 year coupon, that means interest will generally come at the end of 1 year, second year and third year. The selling of the bond can take place somewhere in between, or these bonds can be lent for the security purpose to someone else for some time. So what we do generally in this the dirty pricing is one question, one type of variety which generally he is not asking now is valuation of the bonds, dirty pricing. That's one part. Second part is when he is lending and borrowing across, then he'll ask you to calculate the value of the bond at this price. What is the price of it? For example, if there is I just received a coupon or I received a coupon 3 months back and next coupon will come after 9 months. Now my value of the bond will not trade at face value. The value of the bond would be trade means basically the dirty price would be a clean price plus 3 months accrued interest. So we'll be applying the concept of accrued interest here. So this DP is nothing but dirty price. It's a clean price plus accrued interest, which will come. Don't worry, we'll come to it and see that out. Bank A enters into repo for 14 days. It's a lending over for a short period of time with Bank B in 10% Government of India bonds. This is the interest which will be getting accrued on the face value of bond. Bond 2028 at the rate 5.65 for 8 crores. Now basically two banks are one bank is lending to second bank the bond for 14 days. Rate of interest is 5.65. So then what is 10%? 10% is the rate of interest on that bond. That bond which carries a 10% interest rate could be, for example, you need the money in a very short term period of a time. So I can lend you I can give you as a collateral, let's suppose, and I can borrow from you the money. At what rate I'll borrow? 5.65 for 8 crore. 8 crore is the principal, this 0 period nominal value, but we have to calculate the present value depending upon bond is standing on what date. Assuming that clean price is that price which does not include any kind of accrued interest. Accrued interest is if last interest was paid some time back, the next interest will be coming after some months. So if I'm standing somewhere in between two coupon, basically if I'm standing somewhere between two coupon dates, the bond clean price plus the accrued interest, the period which has lapsed, is called the dirty price or the full price. The assuming clean price is 99.42 and initial margin is 2%. What we do with initial margin I'll do in the practical sum only, and days of accrued interest is 262 days. You are required to determine the dirty price. Now that means 262 days have already lapsed. We are standing last payment, that means came in 0 period, and after that will come after this, and 360 days he says. Accrued interest, that means that bond has got accrued interest of 262 days. Sir, but bond is only for 14 days. Bond is not 14 days. 14 days that bond is used for the borrowing and lending. That is used as a borrowing and lending. Bond is a bond only which carries a rate of how much percentage? 10%. So dirty price would be equal to, it's a clean price plus what? Accrued interest plus the accrued interest which comes out. So when we try to solve it out, my clean price, my accrued interest would be, sir, what? accrued interest would be on face value. AI is accrued interest. 100 into 10 by 100 into how many day lapse? 262. That means it's 7.28. So my clean price was 99.42 plus this. That means my value of the bond today should be what? 106.70. That's the first part answer. If you want that, you can copy from here, dirty price. Although answer is given, I think, but you can copy if you want. Just make a small change if you want here. It's a, instead of 100, I think it's a 360 days. Price is okay, 106.5. Even if the question would not have asked you to calculate this dirty price, still you will be calculating this dirty price. So come to know in the second part. Now actually what happens in this process is, if I try to show you the process, for example, a lender will give a cash to the borrower and he'll take the security, and then after repossession time, the borrower will give back cash and interest to the lender, that is 5.65, and he will give back the securities. Actually, if you would have seen, you can correlate this with something of the bond transaction which used to happen a long time back, 1990s, or maybe you would have seen the, I think, series came, Harshad Mehta was saying 15 days transactions used to happen. Not exactly same, but basically here is, for example, I have the money, I have the money and you need the money, and you anyhow invested, so I give you for 14 days short term period of a time, and the security is with me. Now the problem which comes here is, in this question, when we start the first leg is basically giving a cash, and second leg is basically receiving back that cash. Now what was your nominal value? 8 crores, but the value of the bond will not be 8 crores now, because the pricing has changed to what? 106.70. If you go back to your mutual fund, we have done some calculation, basic calculation, in which we did 100 rupees bond trading at 106.5. I think one of the questions we would have done, or basically when you do the valuation of a bond, 100 rupees value, if it becomes 106.5, then you revalue. I think question number 26 or somewhere we would have done. In this case, what will happen is, if this 8 crore nominal value, if this 8 crore was a nominal value and 100 rupees value becomes what? 106.7. 2% margin means basically when you give something, this is not an income or a loss for anyone. It is only, for example, you gave me 100 crore worth of paper, I am funding only 98% to you. That's it. So I am funding only 98%, so I am funding 98% of it, 2% margin. So it's 100 minus initial margin by 100. That means the first leg was loan amount, or which the amount which exchanged and was 8 crore 36,52,800. At the end of 14 days, this will be reversed with how much interest? The interest component which was decided was 5.65. Sir, what about 10%? 10% will keep accumulating on that bond. That will be ultimately whosoever is the owner of the bond. It's only that is used. For example, I do not have a cash, I need a cash for certain reason. For example, in practical life, what happens is, for example, I have a FD and I need some money. I don't want to break my FD, for example. So I'll give my FD, or you give the house papers to someone and get the money back. Exactly same way it is working as what? Collateral. So the first part is, even if he says na, second part first, in that scenario also you will have to first calculate the dirty price, then calculate what will be the value of that bond which is used for the exchange. The value came basically 8 crore 36,52,800, and at the repayment, this is called second leg. At the repayment, what happens is, sir, at the repayment of maturity, it's a start proceed into 1 plus what? Repo rate into how many days they were doing the transaction for? 14 days. They were doing the transaction 14 days. That means they reverse back. This transaction gets reversed. So first leg is basically starting of a transaction, and the last leg is basically reverse of that transaction. Another type of question which comes is the reverse calculation in this, which is not there in book. I'll just test you on that. If you're comfortable with this, I think same thing I would have done it here. Yes, same thing I've done it here. At the maturity. Now, can I move back? Let me try. Let me not, let you try. this is not there in your book. Something I have done, but I'll not show you what exactly done. 60th question. The bank enters into repo for 9 days. That means interest would be calculated for 9 days. 6% is the bond rate. 2 crores other relevant figure. First leg means when they would have started. Second leg means when they would have come back. Initial margin and days accrued interest 360 days. Calculate the repo rate. If you know the first leg and the last leg, reverse calculate. Calculate for me the 3 prices quick. I think I have taken from study material. Just calculate. Since you have the formula with you in the question number 66, you can apply that formula. Second leg is equal to first leg into something something into something something. Second leg is whatever the initial proceeds into 1 plus r by 100 into number of days, I think 9 days. If you calculate the first part, answer let me know. Repo rate, anyone calculated? How much? 5%. Repo rate. Second leg is equal to start proceeds in 1 plus repo rate number of days by this. Basically say in the first leg it's a seller sells the security and receives cash. In the second leg, securities are repurchased by the original seller. Repo has 2 legs. In one leg, securities are sold, and second leg, securities are repurchased. Dirty price, anyone who has done the calculation? 101 point? 101.330. I have first leg is equal to nominal amount into dirty price by 100, 100 minus initial margin by 100. When I solve this, I think get 101 point. Check once. First leg is equal to nominal amount into dp by 100 into dirty price is 101 point. Third, he asked what? Take the calculation, because from the first we know the nominal amount also, we know the first leg amount also, margin we know 1.25, dirty price we need to calculate. What was third party asking? Can I go move back? Third part is clean price. I'll just down further, calculate it. Clean price is, dirty price is nothing but clean price plus just accrued. One area of a mistake I think some of you might make, which anyone can make in a hurry. How much clean price you are getting? 97 point. Anyone else? Any other price? How much? 97.30. Anyone else? Any other price? Dirty price is clean price plus accrued interest. It's 97.30. Because area of a mistake is actually, this has to be done on the 100. This has to be par value 100. Done. One more question which generally comes here, notes will not have, I'll discuss with you and trouble you in the exam mathematically. First, forward rates. Actually, this is a mathematical question which is not there in notes. I'll just quickly discuss from here only. It's a forward rates which comes out. It's a 1 year rate basically. R1, R2, R3, R4 you call it as. What we do is, for example, we have 1 lakh rupees face value. These are different bonds which have different maturities. If someone has 1 year maturity, only R1 would impact. If someone has 2, R1 and R2 would come, and this R1 would be same. Forward rates are 1 year rates. Interest rate 0, 10.5, 11, 11.5. We need to calculate 1 year rate. It's they have given you face value. They'll give you the current market price. That means 0 period. In first case, there is no challenge. 1 lakh rupee closing value. It's a compound amount. Present value is 91. What would be my yearly rate? So R1 would come. The moment I get R, basically what is the concept here used is, till now whatever you've done is you take 10% interest rate and then you divide first year factor, second year factor, third year factor, fourth year factor based on the 10%. Or you can also do 1.10 to the power 1. Second year you will do is 1 divided by 10 to the power 2. Another mathematics which I want to do is, let's suppose if you have a constant number 0, 1 and 2, first year factor is what? 0.909. Second year factor would be 0.826. Just come from second to first year. Just come from second to first year. 10% only, 0.909. When you multiply 0.909 into 0.909, it will become what? 0.826. Understand what I am trying to tell you is, generally when you have a single year factor, what you do is, discounting factor you do is 0.909, 0.826, 0.751, 0.683, 0.621. Even if you do 0.909, second to first 0.909 and then 0.909 will come at same place. Or when you divide 1 divided by 1.10 to the power 2, 1 divided 1.10 to the power 2 will come at same place. When you get different discounting rates, these are different yield rates, kind of yield rates, R1, R2. So when you are first year, what you do first year is, in the first year, question number 30, 31, I have a text lengthy question. So when I do 31 1 year rate, it's 91,000, 1 lakh. I do is future value, it's actually formula of a principal is equal to compound amount divided by 1 plus r. I get r1, I get 9.89. I get 9.89. Now second year, I'll just show you the number and then we'll say what to do. Second year, it tells me that if I invest in a bond which has 1 lakh face value, which has 99,000 today's present value, coupon we are getting what? 10.5. It means 10,500 first year will be discounted by 1 plus r1. The second year would be 10,500 plus 1 lakh, that will be 1 plus r2, that will come from second to first year, and then first to 0 period would be 1 plus r1. I do not know r2, so I calculate r2 accordingly. It's 99,000 present value, just keep this in mind. And third also keep in mind 1 lakh, 11% and 99,500. So what we get from the second year graphical presentation is, if I look at second year graphical presentation here, forward rate of 33. It becomes heavy when we forward rate of second year is, I'm standing in the 0 period. First year I1 I get this, second year I2 and redemption value I get this. Basically second year will come to first year and then first year will be discounted to 0, r2 and then discounting by r1. R1 I know because I already calculated in first year. So when I solve it mathematically, we get interest of first year divided by 1 plus r1, interest plus redemption will be 1 plus r2 by r1. Actually if you try to look at, it's 1 year discounting, it's second to first, first to 0. So this is something could trouble you, because till now whatever you've seen is single year discounting, or by present value factor, which is single year present value factor, you multiply 0.909 or 826. But if you do 1 year, you're doing the same thing, it's 0.909 into 0.909. Since the r1 r2 are changing, accordingly things are changing, and then using that you can calculate. For example, today value was 99,000, first year interest by r1, second year interest plus redemption value 1 plus r2, this will bring to 0 or 1 year, and 1 to 0 will be this part. Then when I go to the third year graphical presentation becomes as, the first year would be r1, second year would be r2 and then r1, third year would be r3, then r2, then r1. That becomes slightly mathematical exercise which comes. So in 1 or 2 more questions, I think this kind of exercise comes in the exam, when he'll give you calculate intrinsic value. Instead of giving you a single lump sum rate, he'll give you 1 year rate, forward rates. So if he gives you 1 year forward rates, so you have to bring third to the second, second to the first, and first to the 0. And same I think fourth year will do. The graphical presentation. So these are yearly rates, and starting point would be, first year will help me in calculation of r1, then I'll have all the factors, then r2 I'll calculate, then r3 I'll calculate, then r4 I'll fine. This you can look at, because this is one type of variety. Second type is small question comes when he gives that my yield, the 100 basis point change will come in the second year, 70 basis point will come in the third year, and you actually calculate r1 as, let's suppose 11, r2 would be 10.25, r3 would be 9.5, and then you use your numbers accordingly. This question I thought was important. I told you discount rates you can calculate IRR way or simple. That's one part I told. I think more or less that's fine. That's it from the bond valuation. In the next class we'll start forex. I'll not start today. Note is also not helping. I'll start with the forex. If you have studied from me, it's okay. If you have not, still it's okay. Do not study anything from home. Do not study anything from and come, because if you try your own brain, nothing will come. I have my own way of doing forex. Notes have been given to them. Either they'll give, not give, they have given today, it's okay. Not given, then ask tomorrow. Or else when you go back home, I've uploaded the notes on the drive also. not try to read them out. Let me spend 1.5 hours with you. Things will become easier. So it's basically you have to unlearn maybe and then relearn. That forex, I have my own way of doing it. Give me some time accordingly. Tomorrow will start same time 5:40. Take care and bye bye. Take care.